Fair share is an overused weasel phrase from the lexicon of politics, as in the rich big companies must pay their fair share of tax. The usual context of such statements is that the speaker wants someone to pay more tax or is defending a high rate of tax, and the appeal to a fair share is meant to override any other considerations. Fairness, however, is a value judgment devoid of objectivity. What is fair is in the eye of the beholder. It is a pliable concept easily bent to serve the political need du jour. This is not to deny that fairness, or equity, and distributional effects, in the language of tax experts, is a criterion of tax policy. But it is not the only criterion. It goes into the mix, along with more objective criteria such as economic efficiency, the effect on incentives, and simplicity. The most recent release of the Australian Taxation Office's annual taxation statistics publication is hardly a barbecue stopper, but it probably could be if its key points were widely disseminated. With a little digging, we learn from it, for example, that the top 20% of income taxpayers accounted for 60% of the tax paid, while the top 1% accounted for 17%. Figure 1 shows the shares of all quintiles and trends over time. Viewing this profile objectively, we can say that the top 20% and 1% also account for outsized shares of taxable income, 46% and 10% respectively. So even without a progressive income tax, high earners would still pay much more than their shares of the number of taxpayers. Figure 2 accounts for this income inequality by expressing the share of tax paid as a ratio to the share of taxable income. Thus, in 2023/24, the top 20% paid 1.3 times their share of taxable income, and the top 1% paid 1.65 times. The next 20% down the income scale paid slightly less than their income shares, while everyone else paid much less. These ratios have been fairly stable over time. That the top 20% are carrying the lion's share of the income tax burden is clear. It takes a bit more digging to work out that their income tax payments alone financed 34% of the entire federal budget, excluding the pass-through of GST to the states. Their share of other federal taxes paid would further bump up that share. These outcomes are the product of a progressive income tax scale, which has become a social and economic norm. In that sense, they are fair, but this kind of fairness also has its limits. How progressive should income tax be? The answer must have regard to the adverse economic consequences of greater progressivity. If the prospect of financial success means aspirational people can only look forward to sharing their incremental income equally with government, then some will dial down their efforts. This erodes self-reliance and the economy's vitality. Taxation statistics was a description of where we were in 2023/24, but future releases will show the impact of even steeper progressivity that the current government appears to want, judging by its tax policy actions. The tax increases on investment income in the recent budget, for example, were driven in part by the view that high-income earners received too much of the tax relief from the capital gains tax discount, negative gearing, and so on. However, even with all deductions and concessions considered, the top 20%, as reported above, still paid 60% of the tax, and the top 1% paid 17% of the tax. Whatever benefit they were getting was being overwhelmed by the tax they actually paid. There is a very good case, reinforced now that capital gains tax has been increased and negative gearing restricted, that the 47% top rate is too high. Moreover, it now cuts in at the historically low level of 1.8 times average weekly earnings. This was the Hawke-Keating bargain of 1985. We will broaden the income tax base, but at the same time slash the marginal rates. Howard Costello cut the rates further and greatly increased the thresholds. That is not the offer from Albanese and Chalmers.